So we're going to cover the difference between joint life and survivorship life. So a joint life policy and a survivorship life policy, they both involve having 2 or more people insured under the same plan. So a joint life policy, for example, is when there are 2 lives insured, but after the first person dies, a benefit is paid out. An example of a policy like this could be a husband and wife both get a policy to protect their mortgage, so that if one of them dies, the mortgage is paid off. So they could have a joint life policy. So in the event that either the husband dies and the mortgage is paid off for the wife, or the wife dies and the mortgage is paid off for the husband. After the death of the first person, the benefit's paid out and there's no longer a policy in force. The premium of this plan is based on the joint average age of the people. So it's based on the average age between the 2 people being insured, and obviously it takes 2 lives. It takes into account that 2 lives are being insured. Now, there's a little less risk for the insurance company in this case because it's between 2 different people dying instead of just 1. So the premium for a joint life policy is less than the premium of each individual person added together. So for example, if husband has one policy, wife has another policy, the premium on each of those plans will be more combined. The combined of those premiums is more than what the premium on a joint life policy would be on both of them, because the risk is spread out between 2 people for the insurance company instead of just 1. A joint life policy could also be used in the case of a business. So say there are 2 business partners and one says, hey, when you die, I want you to be able to, or if either of us die, I want the survivor to be able to hire someone to take over your role or be able to buy out that portion of the business from whoever inherits it or something like that. So joint life can also be applied to business as well. So remember, joint life is a first to die policy. So the first person to die in a joint life, after the first person dies, then the benefit's paid out. A survivorship life policy is a second to die policy. So in this case, say husband and wife both have a policy. They are involved in a survivorship life policy. If the first one passes, there's no benefit paid out. It has to be after the second one passes that the benefit is paid out. So the policy premium on a survivorship life policy is going to be a lot less than it would be on a joint life policy. So you're going to have, I'll kind of give it an order of premiums here. So husband and wife both have a policy on themselves, 2 separate policies. The combined sum of those premiums is going to be more than it would be on a joint life for a first to die policy if they were both in a joint life, or after one of them dies there's a benefit paid out. Now in a survivorship life policy, that's going to have the lowest premium of all of them, because the insurance company says, okay, after the second person dies there's going to be a benefit paid out. So it's taking into account 2 life expectancies. So since it's going to take them longer to pay out, assuming they don't die at the exact same time, which usually doesn't happen, right? And hopefully for the family it doesn't happen either. So in a survivorship life, it's going to be a little bit cheaper. So the most important thing that you want to take out of this is that in a survivorship life, it's a second to die policy benefit payout. In a joint life, it's a first to die. And the premiums will be lower on either of them than what the sum of the premiums would be if each person had separate policies. And the premium is based on the average age of each of the people. So the whatever the age is, if one's 60 and one's 80, it'll be based on 70 years old.